Good morning and welcome to Stefanutti Stocks' financial results webcast for the 12 months ended 28 February 2023. This presentation will be available on our website later today. I will start with environmental social governance, followed by an update of the restructuring plan and operational overview. Yolanda will then present the financials, after which I will then discuss industry-related matters and close with our strategic objectives. There will be time at the end of the presentation for questions. Our environmental social governance ESG strategy allows a group to manage the risks associated with ESG services using effective ESG practices. The group has its own software system that measures all ESG metrics. Our people are our real enablers, our biggest assets, and instrumental in our success. The group currently employs over 6,000 permanent employees, with the following investments made in our people: 8 million on skills development training, 2 million on 87 scholarships, 1.5 million on 74 bursaries, and 1 million on health and safety training. Stefanutti Stocks has its own academy, registered with a mining qualification authority, allowing it to train and qualify operators and drivers. The Academy has memorandums of understanding with CETA and MERCETA, allowing the group to provide all construction-related training and apprenticeships in-house. Governance. The group follows the 3 lines of defense model, with the board of directors ultimately responsible for the risk management of the group, setting the overall risk management strategy and ensuring that the group has appropriate risk management practices in place. Exco and senior management are the first line of defense. Operational and line management are the second line of defense. Our external accreditation service providers, internal and external audit being the third line of defense. Various other external assurance providers assist on an ad hoc basis. The group is considering moving to 5 lines of assurance model, which is superior to the 3 lines of defense. The difference lies in the addition of key roles identified for senior management and the board of directors. The group endorses and supports the 4 governance outcomes as set out by King 4 report, which are ethical culture, good performance, effective control, and legitimacy. The application of King 4 principles are assessed and reviewed on an ongoing basis. The group prides itself on its health and safety performance. Management and staff remain committed to our health, safety, and environmental policies and procedures, and together strive to constantly improve the group's health, safety, and environmental performances. The group ensures legal compliance on all projects and strives to exceed best practices and industry standards and norms. There were no fatalities during the year. The group's lost time injury frequency rate and recordable case rate at February 2023 was 0.05 and 0.44 respectively. Although the group experienced lost time injuries during the year, focus has been placed on the sharing of lessons learned and the implementation of effective interventions to prevent reoccurrence. The group is ISO 45001-2018 certified. The group has the following quality initiatives: elimination of reworks, customer satisfaction surveys above 80% minimum benchmark, digitizing our quality system, and ensuring consistent outcomes. The group is ISO 9001-2015 certified. All on-site documentation and record management is paperless archiving. The group reviews and revises its environmental policies annually to ensure continual improvement of its environmental management system. There were no significant environmental incidents nor legal transgressions. Legal compliance and exceeding best practice remains at the forefront of all operations. The group is ISO 14001-2015 certified. The group continues to be a level 1 broad-based black economic empowerment contributor, measured against the criteria of the construction sector charter with the following scores: Black ownership 72.26%, management control 56.83%, employment equity 74.34%, skills development 119.44%, preferential procurement 100%, enterprise development 100%, with 10 companies active on our program, socio-economic development 120%, corporate social investment spend of over 1.8 million. Most of these scores show an improvement, with only 3 the same as last year. The group has 2 VLP partners, Axis and Grinica LTA. The construction sector is one of the least digitized industries in South Africa and globally. While this is largely attributed to the complexity of the industry, the power of data can no longer be ignored. Digitization is at the heart of everything, and when properly harnessed, can fundamentally increase productivity. The group has a digitized core business process with the right software, providing real-time dashboards to give insights and foresights in decision-making. We have also embarked on artificial intelligence initiatives to improve decision-making. We have a number of sites using Building Information Modeling BIM, with implementation on all new sites, ultimately harnessing full 5D. The group is in the process of achieving ISO 27001-2022 certification, which focuses on information security management. This standard assists organizations to become risk-aware and proactively identify and address weaknesses. It also gives our stakeholders confidence in our information security. Restructuring plan update. The lenders provided the group with funding of 1.2 billion, of which 45 million was repaid on 15 November 2021. On 28 February 2023, agreement was reached with lenders to extend the capital repayment of the loan as well as its duration to February 2024, with a residual balance of approximately 420 million. Interest on the loan is serviced on a monthly basis. The group continues to evaluate an optimal business model and associated capital structure. The sale of non-core assets. During the period, 2 industrial properties were sold for a combined value of 33 million. The sale of certain operations. The transaction relating to the disposal of 49% of the entire issued capital of the United Arab Emirates operation became unconditional on 18 July 2022. The group received an initial purchase consideration of 92 million on 8 November 2021. The following amounts were received against the purchase consideration: 11 million in May 2022, 8 million in October 2022, and 16 million in April 2023. Regarding the sale of the Mozambique operation, the requisite approval of shareholders was obtained on 22 November 2022. The implementation of the transaction remains subject to fulfillment or waiver of one last outstanding condition precedent. As noted in the circular, the long stop date of 28 February 2023, which could be extended at the election of the group to 30 June 2023. The group has extended the long stop date to deal with the last outstanding condition precedent. The group will update shareholders regarding the fulfillment or waiver of the remaining condition precedent and the implementation of the transaction. Recovery of historical slow-paying receivables. With respect to the outstanding amounts due by the Zambian government, the timing and quantum of receipts remains irregular. 21 million was received during the year. We anticipate collecting the outstanding 28 million this year. Total plant sales of underutilized plant and equipment to the end of April 2023, including plant that had reached end of useful life. 296 units had been sold, with a sales value of 98 million and a net book value of 60 million, with 37 units remaining available for sale. We anticipate completing all sales this year. The winding down of contract mining subdivision. 162 units have been sold for 240 million and a net book value of 199 million. 42 million of outstanding installment sales were settled. This sale process is now complete. Marine, 11 units have been sold for 15 million and a net book value of 7 million. 44 units remain available for sale. We anticipate completing all sales this year. SSBR Joint Venture Package 16 update. Construction is complete. A management team is on site to attend to the final commissioning of Unit 6 once Eskom provides the necessary services. A small team of clerical staff will remain on site until the end of July 2023 to close out contract documentation. Measurement, the final account is largely agreed, pending a small number of variations which are linked to the delay and may end up being resolved as part of the claim process. Further certification from the measurement process is unlikely at this stage, apart from payment to conclude the commissioning activities, which are being reimbursed on a cost-plus basis. All contractor claims consequent upon events or circumstances giving rise to entitlement for extension of time plus costs which occurred before 31 December 2019 are considered to be Claim 5. SSBR and Eskom continue to participate in the claims resolution process, which involves independent experts in the support of Dispute Adjudication Board, DAB, to evaluate the causes of delays and the quantification thereof. SSBR has submitted the following claims to the DAB and Eskom. As disclosed in the interim results on the 24th of November 2022, a site-wide or White House claim of 337 million and a subcontractor site-wide claim of 194 million. As per the SENS announcement of 21 December 2022, a section-specific claim of 438 million and a claim of 171 million for damages due to the financial cost of funding being incurred. The total value of these claims is 1.14 billion. These claims are based on the delay analysis as calculated by SSBR's delay expert and will be adjusted once the delay analysis is complete and agreed. Interest on all claims will only be calculated once the contractor's entitlement has been quantified. Delay. The contract comprises 77 sections and both parties' independent delay experts have completed all analysis and submitted their final differences to the DAB for a decision on the delay entitlements. Phase 1, access-related delays. The experts have agreed a total of 49,153 days. This phase is now complete. Phase 2, construction-related delays. The experts have agreed delays totaling 25,195 days. This phase is now complete. Current agreements with respect to phases 1 and 2 give rise to a 4-year extension of time to November 2020, equating to 203 years delay, taking into account delays to all sections. The original contract duration was 6 years with a completion date of end November 2016. Phase 3, commissioning-related delays. The DAB and delay experts will now start to engage. We anticipate reaching agreement by August 2023, following which a final delay expert report will be drafted by the experts and issued by the DAB as an interim decision in terms of the process. Over the past few months, independent quantum experts have been compiling schedules of differences, setting out their principal differences. During March 2023, the quantum experts had their first meeting with the DAB to discuss the schedule of differences. All parties are committed to have the DAB issue a final decision for Claim 5 this year. However, in terms of the contract, a party may issue a notice of dissatisfaction with the final decision and refer the dispute to arbitration. All contractor claims consequent upon events or circumstances giving rise to the entitlement for extension of time plus costs which occurred after December 2019 are considered to be Claim 6. There is an element of overlap between certain Claim 5 events, the effects of which have impacted on the critical path with respect to Claim 6's period. Therefore, Claim 6 will be dealt with once the Claim 5 entitlement has been resolved, taking into account any overlap between the respective claims. These same quantum principles relating to Claim 5 will be applied to Claim 6. All parties are committed to have the DAB issue a final decision for Claim 6 this year. However, in terms of the contract, a party may issue a notice of dissatisfaction with the final decision and refer the dispute to arbitration. Claims recognition. On final award from the DAB, the entitlements that will emanate from Claims 5 and 6 will then be recognized in the financial statements. Stefanutti Stocks Izazi Joint Venture Package 28 Update. During June 2018, the JV commenced adjudication proceedings in relation to numerous compensation events which had not been assessed by the engineer. During February 2019, this contract was terminated due to Eskom's inability to provide access to the JV to complete the works. The engineer issued 2 negative final payment certificates in August 2019 and April 2020 respectively, alleging overpayments had been made. The alleged overpayments were for measured work and compensation events. This prompted the notification of many new disputes, which were then included in the adjudication process. Adjudication hearings were conducted during November 2020 and February 2021. As several disputes relate to measurement of the works, the JV and Eskom have embarked on an independent expert process to resolve these disputes. In order to accommodate this independent expert process, the adjudicator has been requested not to publish his decision. The measurement of the works is complete and a final value has been agreed. To resolve the measurement of compensation events, a further agreement has been reached that sets out the process. It is anticipated to have all outstanding matters resolved and agreed by October 2023. The group is confident that the final payment application is accurate and therefore no provision for overpayment has been made. Operational overview. In line with the restructuring plan, the group has initiated a disposal program to sell identified operations which have accordingly been classified as discontinued operations. Consequently, the results for the year and the comparative period have been prepared to reflect continuing and discontinued operations. The group continues to deliver satisfactory performance on a normalized basis. The results were affected by the suspension of a significant mechanical contract in the inland region and the late award of a major building contract in the coastal region, resulting in a reduction in contract revenue and an increase in holding costs, impacting operating profit. I shall now cover the key indicators for continuing operations. Contract revenue of 6 billion is similar to the restated comparative period. The group is pleased to report a solid operating profit of 101 million compared against a restated operating loss of 107 million. There are no material loss-making contracts in the group. This remains a core focus for the group. The group's order book at March 2023 was 6.8 billion, a 28% improvement against 5.3 billion for the prior year. Cash on hand improved by 152 million from 409 million to 561 million. The other financial indicators will be covered by Yolanda. Included in the results are the following abnormal and non-operational costs. Restructuring costs and abnormal legal fees of 56 million and fair value adjustments relating to plant and equipment of 14 million. Excluding these amounts, normalized trading would have been an operating profit of 171 million at a 2.9% operating margin. Although current liabilities have exceeded current assets for the past 5 reporting periods, the group has been able to successfully complete contracts to the value of 34 billion. Thanks to the continued support of lenders, our operations are not hampered by working capital constraints. The lenders continue to provide guarantee support for current and future projects. Over the same period, when excluding the funding loan, the deficit between current assets and current liabilities has reduced significantly from a negative 301 million to a negative 20 million. The group has completed its internal restructuring, with mechanical electrical piping now forming part of the inland region. The group has established a renewable energy discipline reporting in the inland region and has been awarded its first contract. I shall now take you through the results of the group's 4 regions. Inland's contract revenue from operations remained at 2.3 billion, with an operating profit of 84 million. All disciplines are performing to expectation, with the exception of the mechanical discipline due to the suspension of a significant contract. We expect the suspension to be lifted in the current year. The results of the materials handling and tailings management disciplines continue to be negatively impacted by the failed sales process. The group is refocusing these operations and rebuilding their order book. With respect to a contract mining project termination, a matter is proceeding to arbitration. This arbitration is expected to commence in the 3rd quarter. The group is confident that the termination was lawful and therefore no provision has been made. The arbitration matter relating to the cancellation of a petrochemical contract that had to be postponed due to a fundamental change in the client's defense. A date for the arbitration is yet to be set. At this stage, the financial impact thereof cannot be quantified. With respect to the mechanical project termination, the arbitration process has been completed and a final award has been made subsequent to year end. In terms of the award, Stefanutti stocks will receive 90.7 million. On receipt, a capital repayment of approximately 51 million will be made towards the loan. In addition, legal fees have been awarded. We await a final value as they are subject to taxing in accordance with the High Court tariff. Coastal's contract revenue from operations has improved to 1.4 billion with an operating profit of 5 million, compared against 1 billion and 3 million respectively. The results for this region were negatively impacted by the devastating floods and the late award of a major building contract. Western Cape's contract revenue and operating profit reduced to 702 million and 30 million, compared against 1.1 billion and 54 million respectively. The results for this region were impacted by delayed contract awards. Africa region's contract revenue remained at 1.6 billion with an operating profit of 74 million, compared against 88 million for the prior year. All operations performed to expectation. Further to the SENS announcement on 30 November 2022, with respect to the arbitration relating to a contractual claim on the construction of the Kalaba-Sikonga-Angola Border Gate Road in Western Province of Zambia, shareholders are advised that the client applied to set the arbitral tribunal award aside, citing contrary to public policy and matters beyond the scope of the arbitration. The hearing was heard on 24 February 2023 and judgment was reserved for 90 days. Inland Region's order book at March 2023 was 3.3 billion compared against 2.7 billion in the prior year, with very little exposure to public sector work. In the short term, there are potential awards of 1.7 billion and future opportunities of 24 billion. Coastal Region's order book for March 2023 was 2.1 billion compared against 1 billion in the prior year, with 62% in the private sector. In the short term, there are potential awards of 1 billion and the future opportunities of 13 billion. Western Cape's order book at March 2023 was 878 million compared against 640 million in the prior year, with 71% in the private sector. In the short term, there are potential awards of 900 million and future opportunities of 23 billion. Africa Region's order book at March 2023 was 523 million compared against 970 million in the prior year, with 52% in the public sector. In the short term, there are potential awards of 2.8 billion and future opportunities of 31 billion. The group's order book at March 2023 was 6.8 billion compared against 5.3 billion in the prior year, with 80% in the private sector. In the short term, there are potential awards of 6.4 billion and future opportunities of 91 billion. I shall now give guidance for continuing operations for the next financial year. Inland region, we expect contract revenue to increase with an improved operating profit margin. Coastal region, we expect a significant increase in contract revenue and operating profit. Western Cape region, we expect a significant increase in contract revenue with a reduced operating profit margin typical of a building operation. Africa region, we expect a slight reduction in contract revenue with a reduced operating profit margin. Head office will continue to incur abnormal costs relating to the restructuring plan. We expect similar costs as currently reported. I would now like to hand over to Yolanda.
Thank you, Russell. The group reports satisfactory results in a challenging environment, impacted by the suspension of a mechanical contract and the late award of a significant building contract. In line with the restructuring plan, the group has initiated a disposal program to sell certain operations which have accordingly been classified as discontinued operations. These disposals are expected to be concluded within the next 12 months. Consequently, the results of the comparative period has been restated to reflect continuing and discontinued operations in accordance with international financial reporting standards. Going concern. The directors consider it appropriate that the group's results for the year be prepared on a going concern basis, taking the following into consideration. The current order book. Imminent project awards. Continuing operations executing the group's order book profitably. The availability of short and mid-term projects. Reaching a favorable outcome on contractual claims and compensation events on certain projects. Continued support from the lenders and successfully implementing the restructuring plan. The funding provided by the lenders has assisted in relieving the group's liquidity pressures, even though total liabilities continue to exceed total assets at 28 February 2023, representing technical insolvency. The group believes it remains commercially solvent based on the cash flow projections included in the restructuring plan and the continued support provided by the lenders. However, the matters as noted above, including uncertainty surrounding the contingent liabilities as stated in Note 26 of the group's consolidated annual financial statements for the year ended 28 February 2022, continue to indicate that a material uncertainty exists that may cause doubt on the group's ability to continue as a going concern, and as a consequence could impact on the group's ability to realize its assets and discharge its liabilities in the ordinary course of business. Looking at the statement of profit or loss, with respect to continuing operations, contract revenue remained consistent at 6 billion for the year, of which the inland region contributed 2.3 billion. An increase in EBITDA from 102 million to 157 million, mainly due to the reduction of restructuring and legal fees and an expected credit loss reversal of 61 million due to the recovery of outstanding debtors. The prior year's expected credit loss reversal was 150 million. The operating profit for continuing operations is 101 million, with a margin of 1.7%. Compared to an operating loss of 107 million of the prior year. The operating profit was impacted by fair value adjustments of 14 million relating to plant and equipment held for sale. Investment income increased to 28 million, of which 13 million relates to the arbitration award regarding the mechanical project termination. Finance costs increased by 16 million due to the increase in the prime lending rate during the year. Interest paid on the funding loan is 115 million for the year compared to 97 million of the prior year. The tax charge has been impacted by the profitability of the cross-border operations. Loss for the year from continuing operations has reduced to 57 million from 271 million of the prior year. With respect to discontinued operations, the discontinued operations reported a profit of 52 million, predominantly comprising the realization of a foreign exchange gain of 71 million, included within reserves, which has been reclassified to profit or loss relating to the disposal of the United Arab Emirates operation, which became unconditional on the 18th of July 2022, and a trading loss of 19 million relating to the Mozambique operation. As mentioned by Russell, the completion of the sale transaction is subject to the fulfillment or waiver of the last condition precedent. The group reports a profit for total operations of 15 million, compared to the loss of 415 million for February 2022. This is a significant improvement for the group compared to the prior year's results. Moving on to the statement of financial position. Other receivables included within non-current assets consists of long-term trade receivables of 54 million, as well as 24 million of cash collateral, which is held as security for certain long-term bank guarantees. Other current assets increased from 2.4 billion to 2.5 billion, predominantly due to an increase in trade receivables of 208 million, with a corresponding reduction in contracts in progress, and a further increase in trade receivables due to the award of a contract on extended credit terms, thereby increasing the debtors days from 58 to 77 days. Non-current assets held for sale and disposal groups of 938 million predominantly comprises the assets relating to the Mozambique operation. Moving to the liability side of the statement of financial position. Total interest-bearing liabilities have decreased from 1.45 billion at Feb 2022 to 1.35 billion. The group, on 28 February 2023, reached agreements with the lenders to extend the capital repayment profile of the loan, as well as its duration to 29 February 2024. Subsequent to year-end, with respect to the mechanical project termination, the arbitration process has been completed and a final award of 91 million has been made. On receipt, 51 million will be used to repay the loan. The group envisages to service the funding loan from proceeds of the Mozambique sale transaction, the sale of non-core assets, and the favorable outcome from processes relating to the contractual claims and compensation events on certain projects. Trade and other payables have decreased from 1.5 billion to 1.3 billion, predominantly due to the recognition of the sale transaction of the United Arab Emirates operation. Excess billings over work done has in total increased by 303 million to 1.2 billion, relating to advances received on recently awarded projects. Of these advances, 150 million is expected to be utilized during the next financial year. There has been an increase in total provisions from 598 million to 649 million due to specific project requirements. Liabilities associated with the Mozambique operation amounts to 659 million. Moving on to the statement of cash flows. The cash flow statement is presented for total operations. Operations generated 63 million compared to the 12 million consumed for the prior year. The increase in other current assets, provisions and excess billings over work done, and the reduction in trade and other payables contributed towards working capital generated from operations of 450 million compared to the 241 million consumed in the prior year. Total tax paid mainly comprises of 41 million foreign taxes relating to Eswatini and Zambia, and 28 million of withholding taxes, offset by a 12 million tax refund for Botswana. Other investing activities includes a further receipt of 19 million relating to the sale transaction of the United Arab Emirates operation and 56 million for the disposal of plant and equipment. Financing activities reflect the reduction in total debt of 113 million as previously mentioned. The group's overall cash position has increased to 561 million from 409 million. In conclusion, from my side, successfully implementing the restructuring plan and focusing on reaching a favorable outcome on contractual claims and compensation events on certain projects remain a priority. I will now hand back to Russell to close the presentation.
Thank you, Yolanda. I will now cover industry-related matters. The group continues to be negatively affected through disruptive and unlawful activities by certain communities and informal business forums in several regions of South Africa. There continues to be a lack of public sector infrastructure spend in South Africa. Should this improve, it will benefit the group. The Employment Equity Amendment Bill gives the Labour Minister the power to determine and set employment equity targets per industry. The risk attached to this amendment is targets being set without meaningful consultation or supported by scientific data. Industry targets have been published for comment. The construction sector is preparing a submission to the Minister objecting to the current targets. In conclusion, our focus is on the successful completion of the outstanding items in our restructuring plan, achieving favorable outcomes from claims and compensation events on the Kusile Power Project, the closing out of ongoing arbitration matters and related processes, and our continued focus on maintaining profitability. This brings us to the end of our presentation. We are now available to respond to any questions. Thank you.